What's up, everybody? This is gonna be my first options video, I think. And I don't know if I'm just gonna kind of give you the basics because I see options popping up in chats all the time. So one thing I kind of want to show you is just what they are, just kind of a probability game. It changes things quite a bit. It took me a while in my trading career to get into options because it always sounded like a scam to me. You would spend less and you would make more, and when has anyone ever approached you with that and it not been a scam? So that's why I've ignored them for so long. But people just keep posting crazy profits, and I'm starting to dig into it and figure out why and how they're getting it. And they're right. You can make some crazy gains. And then when you listen to the professional traders, they talk about it not being sustainable. And what I'm talking about is buying calls and puts, and the very basic is you're buying a contract to buy 100 shares at your strike price, saying I want to buy this is Tesla, I want to buy 100 shares at $330 by December 6th 2019. That's your expiration, that's your coupon to buy it at that. You know, there's in the money, out of the money. It's this little shaded area because right now Tesla is above 330. It was at 352. So that's why up here is your out of the money. We haven't quite hit there yet. So just the very basics. What makes this so dangerous? You're buying a coupon. Okay, you are saying, I want to get this later. I want that deal later. I want it now. Imagine me selling you a coupon. And let's say this 370. This is your strike price. Right now it costs, where's the mark? Where are we at? 370. So 572 is the in between, and that's your mark. So these have 100 multiplier. So you're talking about $5.72. Actually $572 for one contract. Now, if this by December 6th pushes all the way up to $369.99, your $572 is gone. 100% of it gone. In fact, if it pushes all the way up to the right at the money, let's say it pushes up right to 370, you could exercise that contract. You will get the 100 shares at 370. You will still lose your 572 because you basically just wash. You lost your premium. So without getting into too much detail, we can start breaking these down. Theta is your time decay. So as you see this is every day your contract is going to lose. Like this one right here, it's going to lose 23 cents off this 460 every day. These do change. Your delta, if you YouTube this, you're going to find out this means for every dollar, let's say you bought this contract for $3.75, every dollar Tesla goes up, your contract will go up 26 cents. You will go from 460 to 486 for every dollar. Now there's more to it because this actually changes as well. But this is also kind of where you can gauge your probability. Right now, your delta is telling you this is a 26% chance that Tesla actually closes December 6th, 2019 at 375. You know, and those odds just aren't really there for you. You know, that 26% chance, it's just going to make it there. That's why when you're at the money, 50-50 right here. It could not. That's what the market's kind of telling you. So you have that, and then you have your premium. So there's the in the money, out of the money, and then you have your break even. Your break even is where you don't lose a penny. Right now you've literally broken even. You bought the strike price, you could exercise the contract, and you've made enough to cover the premium that you paid for the contract. So if you want to know your probability on this, so here again, let's go with 350. 350. You think it's high? You got a 55% chance. You have to add $13 onto that because you just paid $1,327 for this contract. So if it goes right to the money, you still lose that. So you'll add your $13 to the 350, which puts us, let's see, that puts us right here, a little bit above this. And now you're at a 36% chance. You're about a 38% chance of you just going to break even, just to not to lose any money. When you bought that call, 38% chance that you will not lose it. and that's it. And that's why you hear a lot of these traders talk about things just are not sustainable long term. Now, there's a whole lot of strategies to this and how you can use these. Now, these were actually built and created for risk management. They're insurance policies. Let's say you have a $2 million position. And it's going up. Your stock's going up. You do see a pullback coming. Now, you don't want to just close out your $1 million, $2 million position. So on that pullback, what you would end up doing is you would buy a put. Same thing as you wanting to go shorting it. This is your buying a call. You want it to go up. Puts, you want it to go down. That's why you're in the money's down here. So the lower Tesla goes, the more these are worth. So you would do that. So let's say you buy that put, and then as your stock sells off, your put is now gaining value, kind of to cover some of that loss. When you have that big position and you see institutions buying these, those are the insurance policies. Just like you buy insurance on your car, you spend money on it every month and you hope you never actually need it. So you have a $2 million position and you buy a little cheap put, you want that to run to zero because you know your actual underlying position just made a bunch of money. Now, a lot of people aren't doing that. They're buying these, they're trading these. There's a whole open market. It is still a supply and demand market in here as well. But to give you the basics real quick, I want to just do a quick rundown on kind of what these are. Again, they're almost like buying a coupon for the ticker. I want to buy 100 shares at this price by this date. And then these numbers kind of tell you how it changes. And I'll go into a video for each one of these and how it changes, how it works with this, how your theta will actually work with your volatility or your vega, how your delta works with your gamma, because your gamma affects the delta. That's why these numbers move and they constantly change. But I've seen some crazy stuff happen multiple times. You guys know I have my own chat, and already I have seen this so much. Someone will come in, post these crazy wins. I've been a part of it because it's fun. You can buy just naked calls, which means you are just buying the call, and that's it. You're going to rock that thing, and as it pushes up, you're just going to sell that contract, and you make a bunch of money. For instance, Google today, Google pushed up $11, I think. Google pushed up $11, and I made thousands. Let me just grab Google real fast. Google pushed up $23. I still made thousands, and I was selling into the strength. So it's a good way to play those tickers that you can't afford. Also at the same time, because this delta moves with every dollar, those bigger tickers that move dollars that aren't even a full percent, you can actually get in there now and make money off of these if they have the right pattern for you. But at the same time, if you're buying calls, it will never, you could be deep in the money, it will never actually be more than a 50-50 shot of you even breaking even. So in the game of probability, in the long-term game, just buying these straight out of the gate, buying calls, buying puts, just naked, nothing else, nothing to back it up, no collateral, you don't really win. And you'll see people on these awesome win streaks. They'll buy calls, thousands of percent. The percent game changes when you buy options. It goes through the roof. But on that same time, there's one guy took his account from $10,000 to $500,000 back to zero. Because as you whole account these options, remember what I told you, 375. If it doesn't hit that, it hits 370. If it's 375 right on the dot, you lose all of that, 100%. So you whole account your $1,000, you turn it to $10,000. You whole account that, you turn that into $100,000. You do that again, turn it to $500,000, and then your next one, you make the wrong play. That $500,000 goes to zero. Whatever you had goes to zero. It's gone in the blink of an eye. And people are doing this. They're seeing these in the chat. So I kind of want to make this video to talk about options, introduce you guys to it, tell you these videos are coming, so at least you know when you're gonna know how to trade them. You're gonna know what people are talking about when you're seeing them in the chats, and hopefully this kind of helps you guys with the I call it options fever. When someone comes in, posts these crazy gains, their losses also just as much. So it only takes that one losing streak when you get to this game over here and not have the right strategy to lose your whole account. So again, just wanted to give you guys the basics, I guess the basic rundown as you're looking at these. These are your expiration dates. That's just how far out they are until expiration. When you're buying a call, you want it to go up. You can sell these contracts. So that's also a cool part is $3.75, December 6th. I can actually sell you this contract for $4.60, which means you pay me that. I collect that on you. And if it never hits this, I get to keep all your money. and that's it. So that can be a very profitable thing, because now there's a 26% chance you get your money back. That looks pretty good for me. That's a 74% chance I get to keep that. Now, crazy things do happen. Things do push up. This still could get some crazy news and push up, and all of a sudden this thing goes to the moon. My risk, I start losing, and I start losing fast. So it's always a give and take. It is never a one without the other. I think that should cover it. Yeah, you got your date, your expiration date. The strike is what you're buying. The right to buy. You don't have to exercise that contract. You don't have to run this thing to the dirt. You can sell. You can sell that contract and just keep the premium, trade it back and forth. So that's what most are doing. You don't need to keep it. Yeah, I guess that's it. More detailed videos are going to come. I don't know how I was even going to structure this one, because I wanted to give just a generic. But now we're going to, as these videos come out, I'll be very in detail, so you guys know exactly what you're looking at, how you can play it, how we can build strategies off of this that make your risk a whole lot better. Your chances of this staying in this game longer and staying profitable also increase if you have the right strategy behind it. Playing the game of probabilities is what this options game is, and you can definitely stack the cards in your favor quite a bit more. So until then, guys, I'll see you in the next video.